Welcome, business and financial enthusiasts. Today we're diving into the financial markets regulatory framework in South Africa. In essence, we're talking about money. This involves identifying and categorizing the processes or steps that make up a complex task or mindset, making explicit the tacit and implicit acts that serve as the rulebook governing financial markets, ensuring fairness, transparency, and stability. Picture a bustling marketplace full of energy and opportunity. People are buying, selling, investing, and borrowing. This is the world of finance, a complex system that drives our economies. But like any game, finance needs rules to ensure fairness and prevent chaos. These rules are what we call financial regulation. Without rules, the financial game could be dominated by a few powerful players. They could manipulate markets, leaving ordinary investors at a disadvantage. Just imagine a football match with no referee. Financial regulation acts as the referee, ensuring everyone plays by the same rules and that the game remains fair and competitive. These rules cover a wide range of activities, from how companies list on the stock exchange to how banks manage their risks. They aim to protect investors, maintain financial stability, and promote economic growth. In essence, financial regulation is the foundation upon which a healthy and robust financial system is built. Just like in a game, breaking the rules in finance has consequences. Regulators, including the South African Reserve Bank, SARB, have the power to impose fines, revoke licenses, and even initiate legal action against those who flout the rules. This ensures that everyone takes the rules seriously and maintains the integrity of the financial system. Introducing the key players, FSCA, Prudential Authority, and SARB. South Africa's financial regulation is steered by three main entities: FSCA, Pennsylvania, and SARB. Each body has a unique role to maintain a robust and equitable financial system. The FSCA ensures fair treatment of financial customers. The PA, housed within SARB, focuses on the stability of banks and insurers. SARB, on the other hand, maintains price stability and serves as a lender of last resort. Collectively, they form the backbone of South Africa's financial regulatory framework. The FSCA is dedicated to keeping markets transparent and investors safe. Let's illustrate the FSCA's role with a hypothetical scenario. Picture a company luring investors with promises of sky-high returns, but their financial reports seem too good to be true. This is where the FSCA steps in. The FSCA would investigate the company's financial statements and marketing materials. They would scrutinize every detail, looking for any signs of misleading or false information. If the FSCA discovers any wrongdoing, they would take swift action to protect investors. The penalties could range from hefty fines to suspending the company's license to operate in the financial markets. This sends a strong message that misleading investors is unacceptable and maintains trust in the system. The FSCA's actions help ensure that investors can make informed decisions based on accurate and transparent information. But the FSCA's mandate goes beyond investigating individual companies. They also regulate the stock market itself, ensuring a level playing field for all investors. They set rules for trading, prevent insider trading, and ensure that market manipulation doesn't occur. The Prudential Authority (PA) is pivotal in maintaining the stability of the financial system. Let's delve into the PA and its critical functions. Picture a bank issuing loans recklessly without properly assessing borrowers' creditworthiness. This could result in a spike in defaults, potentially destabilizing the entire financial system. This is where the PA intervenes. It requires banks to maintain specific capital adequacy ratios. Banks must hold a certain percentage of their loans in reserve, serving as a buffer against potential losses. The PA also examines banks' lending practices to ensure they are prudent and not excessively risky. Through regular on-site inspections and off-site monitoring, the PA closely monitors financial institutions. They evaluate the institution's risk management frameworks, governance structures, and compliance with regulatory requirements. If the PA detects any weaknesses, it can direct the institution to take corrective actions to mitigate risks and enhance its operations. The PA's proactive approach aims to prevent financial institutions from failing, protecting depositors' savings, and maintaining the stability of the financial system. By ensuring that institutions are managed prudently and hold sufficient capital reserves, the PA plays a crucial role in averting financial crises. The South African Reserve Bank, or SARB, stands as the guardian of the financial system. Picture a sudden economic shock causing panic in the markets. Investors rush to sell assets, businesses face challenges, and banks become hesitant to lend. The SARB intervenes as the lender of last resort. They provide emergency liquidity to banks. This action prevents a domino effect of bank failures. Additionally, the SARB manages foreign exchange reserves to stabilize the currency. Their primary mandate is to maintain price stability. They set the repo rate to control borrowing costs. The SARB's actions reverberate throughout the entire economy, ensuring the stability and resilience of the financial system. ABSA Bank and NASPERS under the regulatory microscope. To illustrate the real-world impact of financial regulation, let's examine how it applies to two prominent South African companies, ABSA Bank and NASPERS. ABSA Bank, one of the largest financial institutions in South Africa, operates under the watchful eye of the Prudential Authority, or PA. The PA scrutinizes ABSA's lending practices, capital adequacy ratios, and risk management strategies. They ensure that ABSA is prudently managing depositors' funds, not taking excessive risks that could jeopardize its stability. For instance, the PA might analyze ABSA's loan portfolio, assessing the riskiness of its borrowers, and the adequacy of its provisions for potential loan losses. They would also review ABSA's capital reserves to ensure they are sufficient to absorb potential shocks to the bank's balance sheet. NASPERS, a global internet and entertainment group, falls under the purview of the Financial Sector Conduct Authority, or FSCA, when it comes to its listing on the Johannesburg Stock Exchange, or JSE. The FSCA ensures that NASPERS adheres to listing requirements, provides accurate and timely financial disclosures, and treats all shareholders fairly. For example, when NASPERS issues a rights issue to raise capital from its existing shareholders, the FSCA would scrutinize the process to ensure it's conducted transparently and fairly. They would review the information provided to shareholders, ensuring it's clear, comprehensive, and not misleading. The balancing act pros and cons of financial regulation. While financial regulation is undeniably crucial, it's not without its critics. Critics argue that excessive regulation stifles innovation, increases compliance costs for businesses, and ultimately hinders economic growth. They advocate for a more hands-off approach, allowing market forces to dictate behavior and encourage competition. On the other hand, proponents of robust regulation argue that the benefits far outweigh the costs. They point to the devastating consequences of financial crises, often triggered by inadequate regulation and unchecked risk-taking. The 2008 global financial crisis serves as a stark reminder of what can happen when financial institutions operate with insufficient oversight. The truth lies somewhere in the middle. Finding the right balance between fostering innovation and ensuring stability is the key challenge for regulators worldwide. Striking this balance requires a nuanced approach, constantly adapting regulations to the evolving financial landscape and carefully weighing the potential costs and benefits of each intervention. Moreover, regulation should be tailored to the specific risks posed by different financial activities and institutions. A one-size-fits-all approach is unlikely to be effective. Regulators must be nimble and forward-looking, anticipating emerging trends and adapting regulations to address new challenges as they arise. The financial landscape is undergoing rapid transformation, driven by technological advancements, globalization, and evolving consumer behavior. These changes present both opportunities and challenges for regulators. The rise of fintech, with its innovative financial products and services, requires regulators to adapt quickly. While embracing the potential benefits of fintech, regulators must also address the unique risks it poses, such as cybersecurity threats, data privacy concerns, and the potential for regulatory arbitrage. Furthermore, climate change is emerging as a significant risk factor for the financial system. Regulators are increasingly incorporating climate-related risks into their supervisory frameworks, encouraging financial institutions to assess and disclose their exposure to these risks. This includes promoting green finance initiatives and ensuring that financial institutions are prepared for the transition to a low-carbon economy. Financial regulation, though often unseen and complex, plays a vital role in our daily lives. It underpins the stability of our financial systems, protects consumers and investors, and fosters economic growth. As the financial landscape continues to evolve, regulators must remain vigilant, adapting to new challenges and ensuring that the financial system remains fair, transparent, and resilient for generations to come.